Marry the house, date the rate, 2-1 buy down, 3-1 buy down, short term, long term, permanent buy downs. We keep hearing all of these terms tossed about in our real estate market today. And what do they mean? And better yet, how can I use them effectively for my situation? We need to increase the affordability out there today with these interest rates where they're at. So I have reached out to my lender that I've worked with for many years. The guy is top shelf, very knowledgeable, been in the industry for 40 years. Coming to us from Glendale, California, Primary Residential Mortgages, Dave DeSousa. I've got him on the line right here, right now. Dave, say hello.
Hello, Cash, and hello, clients. Hello, team. This is Dave. I've had the pleasure of working with Cash now for quite a few years, and it's been a good ride. And this is definitely a different market, but nonetheless, I'll do my best to answer the questions and field them, so that we can ultimately provide information to continue to be a resource for Cash and his clients.
So, Dave, share with me what you're experiencing right now in the lending side of things right now. I mean, you've got to hear people complaining and having issues and problems, and I know you're solving a lot of them as I am on the real estate end of things. But let's do that, if you don't mind, real quick. Just give kind of a quick summary of the difference between the short-term buy downs and the permanent buy downs, because I know everyone's out there wondering, okay, how does that look real quick on the surface, and what does that cost me? What kind of money are they going to have to bring to the table for that? As we know, the short term is going to cost a whole lot less, but be shorter term.
There's two types of buy downs. A permanent buy down is nothing new. It's always they've both always been there, but a permanent buy down means you're going to pay a certain amount of money now, and you're going to buy down the rate permanently for the life of the loan.
Right.
Meaning, if the going rate was 7%, you're going to permanently buy it down to, 6.75% or 6.5% or 6.25% or 6%, and it's always going to be at that lower rate. It's never going to come back to 7%.
Right. That's your secure bet right there. If you're worried about the market, that's what you want to go with.
And it's also a little bit more expensive. For a permanent buy down, and this is approximate, this is not exact, but on a permanent buy down, for every 1 point or 1% of the loan amount you pay up front, it will buy down the interest rate about 0.25% over the length of the loan.
Okay, that's what I'm hearing. That's what I understand. Yes.
Now, not to be confused with a completely separate animal, which is exactly what it sounds like, a temporary buy down. Temporary buy down means you're not looking to buy down, and temporary buy downs are typically less expensive than permanent buy downs. With a temporary buy down, you're only looking to buy the rate down for a shorter period of time. So you could spend the same amount of money on a temporary buy down as you would on a permanent, and get a lot more bang for your buck for the short run.
Right.
For example, if you had a note rate of, let's just say for the sake of argument, 7%, that was the going rate.
Okay.
On a permanent buy down, you spend 1 point, you're only going to drop it to 6.75%, but for the life of the loan.
For the life of the loan, right.
On a temporary buy down, you could spend 0.75 of a point or 0.8 points and buy it down to 6% for 1 year. Or if you wanted to spend, let's say for the sake of argument, you spend about 2.25 or 2.3 points, you can buy it down to 5% for the first year, 6% for the second year, and then it'll go back to 7% for the remaining life of the loan. And these temporary buy downs are very, very popular in markets where interest rates may be elevated. And what's going to happen is either you're going to sell the home and be out of it within a short period of time, or more relevantly, rates are anticipated to come down by the time that the buy down is finished. Especially right now, that second scenario is what's very, very applicable to our present situation. We're looking at rates that are, in the mid to upper sevens, and in some cases, right around 8%. And there's also a very good probability that 6 to 12 to 18 months from now, interest rates as a whole will be lower than where they are now. So the perfect solution to that is something like a temporary buy down. You don't need to spend all your money to buy the rate down permanently. You just buy it down temporarily long enough until rates come down. So does that sort of help illustrate the difference between
It does, yeah. It paints a good picture. So just to clarify real quick, so if the note rate is 7% at the time that somebody wants to do a temporary buy down or short-term buy down, and they buy that down to 5% for the first year, and then it goes to 6% the second year, and then it would go to 7%, whatever the note rate was for the third year, and the remaining 27 of that, if it's a 30-year loan, correct?
Right. Correct. And that's if they do nothing with it. Correct.
Right.
Now,
And the idea with that is that within that 3 years, they refinance out of it. Either they're going to sell their home or refinance out of it.
correct.
When the rate lowers.
Correct.
If the rate doesn't lower, they're locked in at that 7% note rate, correct?
Correct. The worst it'll ever go is 7. So it'll be 5% for the first year, 6% for the second year, and 7% for the remaining 28 years of the loan. It'll never go above 7.
Right.
Always have the option of refinancing it into lower than 7.
Right.
If the rates so facilitate, which there is an extremely high probability that they will now. Because
right.
And the whole reason rates are up to where they are is because the Fed had to step in and slam on the brakes instead of hovering over the brakes and lightly braking for, a quarter mile. They decided to wait till it was about 200 feet and then they slammed on the brakes.
Right. Right. Exactly. Okay. I'll tell you, I love the way you use the car analogies of slamming on the brakes 200 feet before you crash. Seeing that I know you're a car collector and have what do you have, like a bazillion cars, 12 or 14 cars or something like that? So,
well,
and you're right.
When you're on the freeway, if and there's a guy in the lane next to you and a lady in the lane next to you, and you see red lights ahead, you got choices. You can either take your foot off the accelerator and lightly brake so that the car just stays where it is.
Right.
Or you can wait till you're 200 feet, slam on the brakes. You still don't hit the guy in front of you.
Right.
But what was in the back of your car is now in the front seat.
Exactly. There you go. Love it.
And I'm not saying that with any judgment, but that appears to be what most people feel is what the Fed did with interest rates. They left them low too long. And then when they did act, they had to act really hard, really fast. And it's created a lot of turmoil in the mortgage and real estate industry.
Oh, yeah. So it's really hard for people, the buyers out there right now, to get a grip or to wrap themselves around this thought that, well, and also maybe you could share with them, because I know there's a lot of buyers on the fence. There's those that start to dip in the market a little bit. They see the rates escalating, and they just take a step back, and they want to wait for those rates to come down. Here's the challenge with that. With pent up buyers waiting on the sidelines, and those rates do come down. Let's say the rates do drop down to 5.5% or 6%, right? We're going to have a lot of buyers jumping back into the market. And with this low inventory, what do you think, Dave, is going to happen with that low inventory and more buyer demand jumping back into the market? What's going to happen?
Well, put it this way. The two things that are going to really help the real estate environment is inventory and rates. And the two, I think the two are going to go hand in hand. Because one of the reasons inventory is lower now is because there's a lot of people who are in homes, and they're thinking twice about selling their homes.
Right.
Not just because inventory is low, but they're thinking, well, I have a 2.5 or 3, I got a 3 or 3.25 or whatever interest rate.
Right.
Why would I sell my home, give up that 3.25 rate, and go back to a 7 or 7.5% rate on the new house?
Exactly, at a new higher price.
Well, and one of the things I say to people is, when it comes to homes and buying homes, and this is something I've learned, and I repeat it like a parrot, but marry the house, date the rate, right? All right. Just to jump back into what I was saying right before we had this technical glitch here, there's a lot of sellers that are not that would normally sell, that want a different house, that want to be in a different location, and they're not doing it because they're interest rate prisoners.
Right. Interest rate prisoners. Yes, exactly. They're locked into that.
And
as long as they love the house, that's okay. If they love the house,
that's not to pass judgment on them. It's just to say, very factually speaking, they're sort of interest rate prisoners. There you're back now. I have clients that we're thinking about that really want to list their home, sell it, and move and buy another house. And they say specifically, well, yeah, Dave, but I got that, that 3.25 or that 3% interest rate. And I don't, why am I going to go get another house? Now, again, to go back to what I was saying, marry the house, date the rate. Understand that while you lock in your capital basis on the purchase of the house, which over time is going to go up, your value is going to go up no matter what over time. But on the flip side, your rate is a temporary thing. It might be a 30-year fixed rate. That only means it won't go higher than what you have. I know clients that have refinanced 3-4 times when rates were coming down. Every time they drop 1%, they refinance again, and they refinance again. So I think what's going to happen is this. There's a lot of economists out there that feel like if they see interest rates start to get closer to the 5% mark, even like 5.5%, 5.25%, you're going to start to see more of a loosening up, more buyers that are saying, okay, fine, and more sellers saying, okay, you know what? I can give up my, I'm ready to give up my 3.25%, 3% interest rate because the difference between 3 and 5 is only 2%. Now, all of this is largely psychological because, again, I go back to my default, which is marry the house, date the rate. But again, because we're human, a lot of people can't see past the fact that, okay, well, I'm going to be in a 7% or maybe bought down 6% rate for the short term. All they see is that's where rates are. And so subconsciously, because that's what's going on for them, that has had a very heavy effect on inventory. So the combination of lower inventory and high rates has been rather crippling for very large sectors of the mortgage and real estate industry, right? And so what I think is when you see interest rates start to improve, when there's a definite trend where the Fed is indicating, okay, we think we see where we've got to go, and I think we're ready to start lowering interest rates. I think we're ready to start considering a possible cut in rates. If you see interest rates improve from where they are now, even to the close to 6% range, people are going to start getting more optimistic. And there are a lot more people that will put their house on the market and sell now at that point, when they get to that point, than they would right now. So that's going to happen. That's going to have two effects which are going to be positive for the real estate market. Number one, you're going to have lower interest rates because the Federal Reserve has indicated that we can start lowering rates. And number two, you're also going to have an inventory, more balanced inventory, because more people are going to bring their houses back on the market. Well, what's the third positive effect that comes on that? The more houses that come back on the market, what do you think is going to start happening to house prices?
Well, that's going to be
they're going to become a little bit more affordable.
A little bit more affordable, depending on the demand. If the rates stay high and demand stays lower and the inventory increases, then we're going to have a price adjustment down. But if our inventory stays or remains where it's at now and the rates drop and there's a lot of buyers on the fence right now and they start flooding back into the market, if that inventory doesn't start picking back up to match it, we're going to have prices go back up.
Correct. It's all about supply and demand. And my hope is, and my feeling is, there are a lot of sellers right now that want to sell, but that don't want to give up. They're interest rate prisoners.
100%, yes.
Because that's a normal market. That's what defines a normal market. And the minute you get to a point where all those people that are sellers can now come back into the fold and say, okay, you know what? Now that there's something for us to buy, now that rates are more reasonable, now that there's a better inventory, and it's going to be sort of an avalanche effect where rates will improve. Sellers that were on the fence will now start to buy or start to get into the selling mode. Buyers will sort of enter cautiously because they'll see that, okay, prices in this are improving. And again, it's a moving target because depending on how that balance moves between supply and demand will have everything to do with prices escalating or prices stabilizing or maybe even improving. If houses coming on the market are coming on the market faster, because sellers are, while they're also good at being greedy, they're also good at panicking. And a lot of sellers could look at this and say, oh boy, wait a minute. I better sell my house before Mary and Paul and John on the block put their house on the market, because once that happens, I'm going to get even less than I get now. So the same fear and greed index, which drives the stock market, that same fear and greed index is also going to play its way into the real estate sector once we start to see a slight movement in rates.
Right. Gotcha. Yeah. So one thing this reminds me of, I remember not very long ago when I was working with buyers and sellers were absolutely loving it, but buyers were just getting drugged through the coals when they wanted to buy a house. They were getting the great low rates, but they were going to go over asking price and sometimes by quite a bit. And they weren't, the sellers were not going to give them any inspection repairs. They weren't going to do anything for them. The sellers were calling all the shots. Okay. The buyers were basically just, here, take my firstborn child. I want the house, right?
Yeah. The buyers were basically being tolerated.
Yeah. 100%. So if those rates drop back down again and our inventory stays where it's at, they're going to be wishing they had done something now. Like you said, marry the house, date the rate. I absolutely agree with that. Come in here, get the house that you like. You don't have to battle out with 20 buyers going over asking price and, not being able to do inspection repairs, not being able to put an appraisal contingency on there. You remember those days, right?
Mm-hmm.
There was just no appraisal contingencies at all, right? So
Well, even
everybody
now,
was
I
rolling
mean,
the
I've
dice,
got
all very
clients, depending on
sweaty.
how much they're putting down, I have clients now that they're writing without appraisal contingency.
Right. Yeah, still. Yeah, I know, I understand. So it always boils down to motivation, right? When I'm talking to sellers and buyers, listen, you ready to make this move? There's the numbers, right? There's the economics of this whole situation. But what's the motivation? Why the move? Is it economics? Or is it, I can't stand my neighbor. I want to get closer to work. I want to get closer to the freeway. My commute's driving me crazy. We got to figure all these things out. I want to get into a smaller house. I want to get to a single story. I don't want stairs anymore. I'm getting older. I got a sore leg, whatever the case might be. I've got kids. I'm having more kids. I need more rooms. Or I've got, my mother's older and she's going to move in with me. I need to get a downstairs bedroom, 2 of them. So these are some of the criteria I get thrown at me. And that's the motivation we find out from the sellers. And why are they going to go to this move? Because moving is a lot of work and it can be very stressful. And that's why our job is to come in there and just iron out as many of those wrinkles as we can and just make a smooth transaction and transition from one property into another. And a lender is such an important, pivotal part of that whole process. And a lot of people don't understand it. Go online. I'm just going to go with whatever lender I come across who gives me the best rate. Boom, they win my business. Instead of understanding the importance that lender is going to be in their ear and they need to answer the phone. They need to get back with them. They need to give them the answers and a confidence of, I've got your back. I'm going to get this done. And sometimes little hiccups happen along the way and you need somebody good to be able to iron those wrinkles out again so we can get the deal closed. And so I always try to explain that to my clients. Of course, use whatever lender you want. That's up to you 100%. But find a good, professional, really good, well-trained lender, just like an agent, same thing. So anyways, I'm glad we've been able to work in that capacity. I wanted to ask you, what's your speculation of rates going forward from here for the rest of the year?
The Federal Reserve, the market has figured that it's most likely not going to be for this upcoming hike in November. They feel that more than likely there's maybe a less than 30% or 30%-ish chance that the Fed will raise rates at November, and more like a 60 to 70% chance that the Fed will leave rates untouched and not raise the discount rate again at their November meeting. Now, the hike is not off the table, but Wall Street largely is thinking this is where it's going to be. The Fed still says, well, we've got one more rate hike to do this year, and we're not sure when it's going to be. So
one more, huh?
Based on this is all going to be driven by the economy. If the job market, right now, one of the concerns for Wall Street and the Fed is the job market is still hot. I mean, just yesterday, Friday, the jobs number came out for September. They were thinking after adding 227,000 jobs in August, they were thinking maybe 170,000 in September. The economy added 366,000 jobs in September.
Jeez, how about that, huh?
So that was not a good time for interest rates, because if the job market is still hot, what does everybody think the Fed's going to do? More likely to raise rates if the job market is hot, because if the job market's hot, people have money, they're going to be spending money, which means that prices don't have to come down.
Right.
Now, on the flip side of that, while the jobs number came out really strong for September, unemployment remained steady at 3.8%. So unemployment didn't drop. They thought unemployment was going to go from 3.8 to 3.7.
Right.
Somehow it maintained at 3.8. So it was sort of a muted response. But my feeling is we're probably going to see rates hold fairly steady between now and the end of the year, maybe into the beginning part of next year. And when we will start to see any improvement in rates is when there is no doubt that inflation is on the way back down to 2%. And the job market is maybe starting to cool off a little bit, because that's what Wall Street's eyes are on now. Is the job market cooling? Does it look like the job market's cooling a little bit? If the jobs number is cooling a little bit, that's going to get everybody a little bit more easy about the fact that ultimately the end goal is what? That the end game is the Feds aren't going to raise rates, right? That's the end game. So
Right.
everything else is being looked at in that one context. Based on anything that happens, is that going to make the Fed want to raise rates? Or, oh boy,
Right.
is that going to make the Fed want to lower rates? I
Exactly.
would
Take
say
it easy, Fed.
probably,
Take it easy.
yeah, I think we are probably not going to see much improvement in rates until maybe the end of first quarter next year.
Exactly, 100%. Dave, let me ask you this question. I've had a few clients of mine, and people mentioned, passerbys, that they hear of a big foreclosure buildup out there, in the residential market. Now, commercial is completely different. Commercial is having its issues right now, for sure. No doubt about that. Industrial is not so much, is what I'm understanding. And but residential, I have heard from people saying, I hear there's a big, of course
Shadow
they're thinking back.
inventory.
Sorry?
Shadow inventory.
Shadow inventory. Correct.
I would agree with that. I was actually just the other day talking to a gentleman in my building, and he says just right here in Glendale, there are many, many, many people he knows that because of COVID, they haven't made payments for 6 to 12 months on their mortgage.
Mm-hmm.
Well, when that relief goes away, and he says a lot of them are not working, so they're very lucky that they don't have mortgages to pay. They've been living free for this last 12 months. It's just going to get added to the loan. But one of them actually came to see him, and the three of us had a talk. And the guy said, "Yeah, I can't pay. I don't. My income wasn't what it used to be. I've been affected by the entire
Right.
economy, and he's
Right.
going to have to sell his house." And so there are a lot of people. When I say shadow inventory, there's a lot of people that have been protected by the COVID deferment of mortgage, in the same
Correct.
way that people have been had just sort of had a little reprieve from student loans because of COVID.
Right.
Student loan payments are starting October. October this month, right now that you and I are talking.
Right now. There we go.
Student loans are due. Deferment is over. That's going to affect millions of people.
Yep.
Number two, COVID deferment for mortgages. Done. Game over.
Yeah.
Number three, a lot of people and larger companies are now saying, okay, COVID deferment is over. You got to get back to the office.
Right.
That means people are going to have to, their expenses for cars, for insurance, for driving, all of those expenses are going to start to go up. So I have a feeling that there's going to be some shadow inventory coming back on the market. And again, I have this feeling that just like anything else, when it happens, it's not gradual. When it happens like an avalanche. So I would agree that there is shadow inventory. I don't know if it'll sort of be a 2008 all over again, but there's definitely a correction coming.
Okay. You feel a correction coming. Okay.
Yep.
So there's a mixed bag of feelings about that and thoughts about that. And I'll tell you, from different people in the industries that I talk to, whether they're investors or home flippers or whatever they might, title escrow, lenders like yourself, talking about what's going on with this shadow inventory and the distressed property market. I looked yesterday, I had a client ask me, hey, let's look at some foreclosures in the Santa Clarita market. There's 4. I looked at the whole entire Santa Clarita market, and 2 of those were actually not, they were short sales. And there was an REO, which is a real estate owned, a bank owned property. And then one was a probate. So there's really just 2, foreclosures and then a short sale. So distressed sales, anyways, there's 3. The probate's not really a distressed sale. There was a death in the home, and they moved on to get that home sold. So that's all there was at this time. That was just yesterday. I just looked. So I think it's just going to be very volatile. Yeah, there's definitely going to be that. There's people that are hurting, and there's people having challenges. I've talked to a few of my own clients that have been, and I think you've had a conversation with 1 or 2 of them as well in our behalf. So one thing that's a comforting thought, though, to where I don't think it's going to be terrible or crushing like 2008, is that we have the highest rate of complete home ownership in our United States of America right now. It's 40 to 42%. I've had different numbers. Heard 40% for low and 42% for high as far as complete ownership, mortgage free. And then we have to look at those that do have mortgages. I believe the number is right around 65% of those mortgages are under 4%. And 25% of those are under 3%. Now, these are some numbers I've been reading from multiple sources. What's your thought of that? What's your opinion of that?
Well, if those, I'm not in any position to refute or negate those statistics. But what I can tell you is if those statistics are true, again, when it comes back to consideration, no matter what the interest rate is, you have to understand a lot of people that bought homes at that time, they bought at the top end of what they could qualify for.
Right.
So if they're in any kind of a situation where because of the economy they're not able to pay that mortgage, it doesn't matter whether it's at 1%, 2%, 3%, 5%, 10%, 8%, 6%, doesn't matter what the interest rate is. If they cannot pay that mortgage, they have two choices. They're either going to lose it in foreclosure or they're going to sell it. So it really depends. It comes back to the ability of the mortgagor, the borrower, the owner, to be able to continue to pay that mortgage. Because
Right.
again, when home rates are 2 to 3%, people weren't saying, okay, well, I'm going to buy half of what I qualify for because I know rates are going to be higher at some point, right?
No.
They all
No.
bought maxed out. So if someone
Max out all the
qualifies for a
time.
certain
Always
house
maxing
at
out. Yes.
3%, and maybe they lose one of the incomes in the house, or maybe there's something going on with their job or their income,
Right.
they're going to need to do something. The people that are safe are the ones that refinance to get a lower rate and could have qualified for easily for double the interest rate.
Right.
And those
Right.
people will have to make a decision. Do the practical concerns outweigh? Do the financial concerns outweigh? Do the mental, the emotional, the physical, which parameters win out? And it really comes down to, do they really want to sell? There may be a lot of people that might just end up staying in their houses long term
Sure.
because of where the interest rates were. But
Right.
I mean, and the only reason I say that is because right now those 2s and 3% interest rates were literally 30 to 40-year historical lows. So while it's possible, it's not impossible that we're going to see those again, but it's not probable. So it's
Gotcha.
fairly likely that people who are sort of on the fence about, okay, maybe I'll sell and move, or maybe I won't, it's fairly likely that those people will continue to stay where they are and not
Gotcha.
sell.
Right.
But there is a vast, large number of people that, the fact that they have rates in the 2s and 3s, it's not a question of they're not going to buy anything. It's just they want to have interest rates be a little bit closer to where they are now. And I think if we get to where rates are in the 5s, I think we're going to start to see an inventory improvement. I think we're going to start to see an activity improvement, and all around a healthier real estate / mortgage environment.
I agree wholeheartedly. 100%. Exactly. You're spot on with that. So, hey, Dave, thank you so much again. It was awesome to chat with you, and thank you for sharing your insight with me and the people that are watching out there. And it's invaluable, man. So thank you for taking the time. Really appreciate that. And hey, I hope we could catch up on another roundtable here again before too long. All right.
Absolutely. Well, thank you. It was my pleasure and privilege to be your guest speaker on this. And besides the fact that I've enjoyed very much working with you, brother, for the last several years,
Thanks,
I
Dave.
also very much appreciate you reaching out to have me be part of this and trusting me enough to, put me in front of your clients and your business people. So I appreciate that, and I look forward to the next one. It's always a pleasure.
Absolutely. And just know I'm very particular about who I'm going to do that with. So, and they've got to align with me with class. Got to have class, number one, right? And intellect. So thank you for that. Also, I'm sure there's going to be changes in the market. There's going to be things happening, but if it gets too interesting and we just need to get some answers, let's get you back on one of these calls again here. So, hey, it was great having you tonight. I hope that you got some clarification on all these crazy terms that are going out there and some of the options out there that can increase the affordability. So you can go forward and make that purchase today. If you have any more questions at all, ever, call me, text me, email me, DM me, throw a stone, whatever it is. I'm always here for you.